I only specialize in what I call the really great bubbles.
What is going on, YouTube? It's Brendan from Market Makers, the Aloha Trader. Guys, great show for you today. We're going to cover the S&P 500, the Russell 2000, and by popular request, I added the NASDAQ. We also need to cover the VIX because that is at a key level. Eric Johnston, our last special guest, was so well received. I've invited to the show Dan Niles from Satori Fund, because here in Florida we love a man with a tan. So Dan is a perfect guest for this. I think you guys will really enjoy his commentary as well. I'm going to ask him a couple of questions. And before we kick the show off, this show is brought to you by SimpleFX. A quick word from our sponsor and me. SimpleFX, the premier exchange to trade worldwide equities, commodities, forex, and of course cryptos. Guys, you can trade anonymously with only an email and a VPN. With the Market Makers link, you get a double first-time deposit bonus up to $5,000 available instantly. You will love this professional platform. Check out SimpleFX. Yes, that is my voice on the voiceover. If that doesn't work out, I always have hand modeling. So may move on to that career. All right, guys, let's go to set the table for Dan. Powell spoke yesterday, big nothing burger. Basically said the same thing he said at the FOMC meeting. Markets sold off, and then they rallied back up, got a nice little FOMO buy up. And then we're going to look at that resistance here. But, you know, to me, this is nothing more than yet another bear market rally. This is what bear market rallies specialize in, is building up FOMO and trapping retail, okay? So, Dan, do you see anything fundamentally different from this year so far versus last year?
Yeah, I don't think things have changed too much. I mean, obviously the stocks are down from where they peaked, but you have to remember last year it was really about inflation and the Fed. And so for the first 6 months, the market went down despite earnings forecasts going up. Then you sort of got to mid-year and earnings forecasts then finally started to come down. And I think what you're going to deal with in 2023 is the aftermath of all of those rate hikes you saw in 2022 starting to play through to earnings. And you've already kind of seen it with some of the bigger tech companies like Microsoft that have reported and guided. Now, obviously, the stocks have gone up, and you can call it the January effect or, you know, whatever you want. But it's typical that the market tends to drive up the stocks that were oversold in the prior year in January, at least to start the year. And, you know, that's what you've seen, right? Communication services, information technology, consumer discretionary, those are the three best sectors this year, up, 8 to 13%. And the best sectors from last year, healthcare, utilities, staples, they're all down for the year. So I don't view this anything more than another bear market rally like we saw last year. We saw 7 of them for 9% each on the S&P 500, and you still finished the year down 19%.
I agree with you. I agree with everything you're saying. But, I guess the bullish case would be if you look at how big tech got beat up last year. There's value there now because some of those big names really got beat up. When I look at big tech, though, I see that, Microsoft had its worst quarter since 2016 for growth. Apple had its worst quarter since 2017. Google missed on the top and bottom line. Do you see more pain ahead for big tech, or do you think this is it and everything's sunshine and daisies from here forward? What do you think, Dan?
Absolutely. I expect every single big cap tech company to report and to have the estimates go down for the March quarter. And in some cases, they could go down substantially. Now, obviously, you can look at this and say, well, Intel had one of the worst guidances ever, and the stock is up still 6% for the month. Microsoft's guidance on Azure was horrific. It was still up 1% for the month. But I think you don't want to confuse stock prices with fundamentals. And right now, you're starting to see big cap tech starting to take numbers down in a very large way. And the problem is valuations don't really discount that because you've still got a trailing PE of the S&P of 18 times whenever CPI has been above 3% over the last 70 years. That multiple has been 15 times. So you're not getting paid to take the risk, whereas you can buy a 3-month T-bill, which was one of our top picks coming into the year, and get a return of 4.6%. That's pretty darn good. So I think you need to balance risk versus reward versus just looking at, well, these are down a ton, and so I can buy them. Well, everything's up in January.
And once again, I agree with everything Dan said. So guys, this is what happens in bear market rallies. Again, we've had 25% rallies back in .com. This is a 20% rally in the S&P, and we're at key resistance level. We haven't had the volume tick up to really show us the big money players are in the marketplace. And if I can just take a second and really explain that concept to you as well, because Marko Kolanovic, chief equity strategist from JP Morgan, one of the top 3 largest investment banks in the world, he came out with a new memo and reiterated he is super bearish on stocks. Again, he's predicting a pull down to the low 3,000s. Mike Wilson from Morgan Stanley won the best strategist last year. Kolanovic won it 12 times. He is in the Hall of Fame. They are both expecting the S&P to pull down towards that 3,000 level. Mike Wilson actually has 3,000, but Kolanovic went a step further and said he doesn't think the S&P will finish higher than 4,000 for the year. Well, the S&P at the time of this recording is at 4,120. So if we're above the top where it's going to be for the year, what does that mean, guys? Even if you think we're only going to trade in a range, you have to descend. And the reason their viewpoint matters is not because that they're going to be right, okay? The reason their viewpoint matters is because the 2 institutions they represent, and you can throw in Bank of America because they came out with a very bearish view on stocks as well. So those 3 institutions they represent as chief equity strategists control billions, if not trillions, when you apply leverage of money that would flow into the marketplace, okay? So you have to understand that. Remember, you are trading against big money at all times. And if big money doesn't step in, which you will see in the volume, you are making tops and you are descending. Where big money steps in here on the weekly time frame on my S&P chart is where they think they have core value. And again, Mike Wilson at 3,000, Kolanovic at something like 3,300. They're expecting the S&P to come down. I have 3,143. And this is the whole trigger to what happens this year. This movement here, when we come down to this movement, the rally that forms, if this rally continues and holds that level, 3,100, 3,000 for support, well, then that could very well be your bottom. And the big banks will think it's the bottom because their chief equity strategists think it's the bottom. They think you're going to be confined between 3,000 and 4,000x. So they just think you're range trading. But I'm here to tell you, if this rally fails and comes back down, then we are going to our bubble target numbers. You have to remember, Morgan Stanley doesn't even have recession as a base case, just a growth slowdown. When you go into a recession, your average decline of the S&P is 35%. Coming down to my 3,143, that is your 34.76% decline. Again, they will think that is the bottom. If this rally fails, then you have to look at the average bubble target, which is 50%. You saw this in the great financial crisis. You saw this in .com. You saw this in the bubble in 1972-73. And that has the S&P at 2,400. And if you overshoot that target because we have some type of calamity, some type of catalyst coming to the marketplace, such as bank failures, a monetary crisis, a government crisis, war, lots of different things could happen, then my base target, my super low target would be 1893 on the S&P. If you guys watched my video when I show the S&P targets, I show you how I get to this number. That is a minus 61% decline, okay? Basically 618, again, Fibonacci, okay? So that's the setup for this year, and it's all going to come down to what happens on this bounce, whether it's 3143, 3,000, 3,200, if this rally holds. If it does not, then we're looking lower. Let's go ahead and bounce over to the VIX before we jump into all charts, because going back a quarter century to .com, the VIX cap for bear market tops has been roughly 17, 18, 19, okay? I went ahead and threw down this white trend line on the VIX here, which is at 18.57, which obviously we hit. Look at our Bollinger Bands, our market makers caterpillar here, 2 and 3 standard deviations on a 50-day trend. Look how this is tightening up. When you tighten up, you have volatility compressing. It's like compressing a spring in your hands and it explodes, okay? And we haven't had compression like this all the way. You have to go back to September of 2021, okay? And you see what happens. The VIX will start spiking up. So we don't know how long it will be compressed like this, but when it moves, when it explodes, again, bouncing off this trend line that we had, it went all the way up to 36 or 37 on the VIX. When this thing opens up, guys, you're going to see the market sell off. And if we look at our key dates again, looking at that spring equinox, remember, this is a market trigger historically. And you heard Dan Niles say the January effect. What is the January effect? Again, I tell you guys this all the time. The people that are active participants in the market, they just call these things seasonality. We have strong seasonality behind us. We have the January effect. That's the winter solstice. Again, going back into all the crashes, the spring equinox, which is March 20th of this year, in that quadrant, give or take a couple of weeks, you had the dot-com crash get triggered in March. You had the bottom of the dot-com crash in the fall equinox just a couple weeks after October 4th, okay? Going to the great financial crisis, you had the bottom of the GFC in March, the spring equinox. So this is going to be a trigger in that quadrant. If we start selling off before we get to the spring equinox, then that could very well provide your bottom in that quadrant where you see the rally form from. If we take that long, we just go sideways in a tight range, then that's going to be your trigger for the move down. This stuff, when you look at it in a macro view, and I've done this in other videos, I did a whole spring fall equinox video, guys. Check out that video. It's the first video I did on the S&P when it was segregated from the other videos that I do. That's all on the equinox dates, going back to the crashes. You see it. And you also saw it in the pandemic crash. When did that happen? Spring equinox. So let's go ahead and jump forward here on the 3-day chart. I shared this pattern with you guys yesterday. We hit the VWAP. Again, what are we doing? We're just making up thrust and Wyckoff. To me, it looks like we're holding our topping range here. The longer this takes for price to move, and look at the volume. The volume is so minuscule, guys. And I'm going to show you this when we get to the NASDAQ as well. You want to see big breakout 3 sigma bars, 4 sigma bars to form a bull run. The volume is super low. This is highly correlated to the retail volume. The largest inflows of retail money came in to buy this rally, and they bought the rally late. Okay, they bought it late, and until you have the big money players step into the market, you're making tops. And again, this is why it's so important to see what the chief strategists from 3 of the biggest investment banks are saying, because they are bearish on stocks, meaning they're advising their clients to not invest in stocks. It's going to be more difficult to move the prices up. At the top of our Wyckoff range, looking for that retracement back down to the trend line, and a reciprocal move here of our Kepler's triangle. Looking at this on the daily, we'll look at support levels and resistance levels. Why do I say the retail came in late? Because a lot of retail guys, just like a lot of basic market analysts on TV, they're looking at indicators like this. They're looking at the 50 crossing the 200, right? Bullish cross. But guess what, guys? This was a 20% rally from bottom here to top. Let's just go ahead and do this. From bottom to top, 20% rally. Where did you actually get the bullish cross? After 17.5% of this rally was already completed. This is why you saw people buy after Powell was speaking, okay? So as you guys know, we talked about shorting this above 41.80, got to 41.95. Right now, price is at 41.30. It got all the way down to, I think, 40.80, 40.87. So this has been a very profitable trade. Some people took profits down here on that last candle since the last video, but on a smaller scale here in the daily time frame, what are you printing? If you just look at my screen, you're printing a double top. You see this? You're printing a double top. And Wyckoff, you are starting to build your range here for Wyckoff as well. So let's go ahead and do this. This would be my mini Koff structure, and let's go ahead and get our climax. And then we'll go ahead and get our base. Okay, we don't have a lot of candles here yet, but this is essentially what you're looking at here. And you can even put this down here. And like I said, guys, what you want to see happen here is basically if the S&P is going to break out, you want to see a move above here. This would be your 4170, 4180 that I've been talking about. This would be your Livermore pivot. You know, Richard Wyckoff's good friend, Jesse Livermore, the first billionaire trader. Your pullback and your move to the upside. That's what you want to see. And this will do the same same pattern as you get more candles in here to the downside. If you start getting down thrust in the range, you can see this in smaller time frames. You pull back, you test your base, and you pivot to the downside. That downside utilizing the fibs, which we can actually use because they line up really well here. So let's go ahead and get rid of this. We'll just look at the fibs. Easier. 40-80. If you start losing 40-80 and you start back testing it and pivot to the downside, that's exiting your trading range here. Your trading range is pretty well established here with 40-80 and 41-66 on our trend-based fib, right? So that's what you're looking at here for the S&P. You want to see one of these two pivots to the upside or to the downside, and right now you just printed a double top. And again, looking at this on the MFI, the money flow index, guys, you have bearish divergence here, lower highs in the MFI, higher highs in price, low volume rally. Looks to be that you are topping out in this range. And could you may even get more entry points here if we do get a little bit more FOMO on some of these candles to come back up again. So I still like the original trade setup. Unless you pivot out and hold above 41.70, 41.80, as you approach those resistance lines, I still like those entrance points for shorts. And if we look at this on, let's go ahead and go to the 3-day chart on the Russell. Looking at the Russell, guys, the Russell, again, you know, here's our VWAP on the 3-day chart. As you can see, we got above it, fell below it. Very similar to this move right here that we talked about last video. You can see all this volume resistance that we have right in this quadrant. The Russell is at 1949. It got all the way down to 1932. And of course, like I said, that video set up, we shorted the Russell above 2000. So once again, highly profitable trade. The Russell, we can see what happens here. This could be your prelim to a bounce back up, giving you a double top, or you could get one of these moves where you just start selling off. So the market's just trying to find some equilibrium today. Let's see what the indicators are doing here on the Russell. The Russell's approaching oversold on the 3-day chart, which you would have to go on the MFI. I mean, you have to go back years. This is all the way back to 2018. You never hit overbought, I should say. You never hit overbought on the MFI, on the Russell, on the 3-day chart, going back years, and it's approaching that. So again, high confluence area. If the Russell does manage to pop back up above 2000, if it looks to be printing this double top, again, I still like that trading opportunity on the Russell. Here on the daily on the Russell, guys, you can see the 1988 was the actual pattern target, as you can see, and we did get above it to 2008. Very, very high performing pattern, I would say. This is a 707, one spot 414. This is your reciprocal move here. And you can see the Russells came down, back tested 1930 essentially at your 786. If it comes back up again, look for 1988 to provide some key resistance. Might get some wicks above it once again, and that will print you this double top, okay? Your double top. And if you do descend more, watch 1884, watch 1930. Your next two key levels down. On the daily time frame, your 200 is all the way down at 1820, which I do envision we will be back testing at some point in the future, okay? This is topping action on daily time frame. This takes time. This takes candles to print. If you look at this on the daily, if the MFI, once again, you had higher highs in price, lower highs in the MFI, divergence, okay? You had bearish divergence. So this is moving as expected. The profits, the trades are all in profit, so very excited about that. You can see this on the 8-hour time frame as well. You can see a little bit more of your double top forming, this big wick down, kind of give you your heart line. So this may be the rollover right here, or you may find support back down at that fib at that 1930 level and then come back up again for a larger double top structure on a larger time frame like the daily. Have to see how the markets behave. Let's go ahead and jump forward to the NASDAQ, guys. So clean chart on the NASDAQ. Let's do a couple of things. Let's analyze this the same way we've been doing all of the indices. Looking at the VRVP, or volume profile. Lots of you guys are asking me about my settings, so let me share that with you. Row size 255, value area volume 70. You can screenshot that or just memorize it, okay? And this gives you these little spiky tops here. But looking at this is going back all the way into the bull run, okay? 3-day chart, all the way into the bull run. Look where your peak volume resistance is. Do you see this? Key area here, this peak area here for volume resistance. You never even got up to test it, all right? So remember, just like on the S&P, when you're looking at Dow theory, you're looking for that 20% move down, right? So here's your all-time high. Your 20% moved down, came down to this area, 22.86, and then your wave back up to try to defeat the bear market. Then you capitulate it back down, try it again, capitulate it back down, and this is yet another wave to try to defeat the bear market, okay? So let's go ahead and look at this. When we start moving this in, I boxed this in Wyckoff just like we did on the S&P, guys. And then what are you doing? From a Wyckoff perspective, you just made up thrust. I mean, look how accurate that is. You got wicks above here. You made up thrust into your Wyckoff ceiling at 12,718, and then you fell below. You have to flip 12,718, pivot out, pivot to the upside. This is your Livermore pivot, okay? Pivot to the upside to have more upward momentum, just like the other indices, because you can see how they all kind of track together. If you break out and just fall back down, this is a failed pivot attempt, okay? You want to pivot and hold that to the upside. If you start falling down on a 3-day chart here, maybe print a double top, fall down, make a lower high, maybe make another double top. You have to watch for the same movement on the downside, okay? So we're going to look at this with fibs. Let me go ahead and get rid of this as well and see if we have any of these same patterns from these charts. Let's get rid of this arrow. From these charts that we had on the other indices. So let's look. We can see we have this bullish Gartley structure just like we had on the S&P, just like we had on the Russell. Here's your low, here's your higher low, and of course, let's go ahead and get the volume on here as well. Through my volume. You can see we had big sell-off volume, right? Look at the candle size. Big sell-off volume, 3 sigma candles, 2 sigma candles, big volume bars, and then we have declining volume left to right. So this is how we want to see this set up. We want to see exactly this. Volume down left to right with a volume divergent rally. You have Wyckoff resistance, volume resistance. Let's take our trend-based fib. Let's measure this low. Come up to this midpoint here. I'm not using that Fed wick from Friday the 13th. And then come down to the next low. You can see we hit the one spot 272 at 12,815. So the symmetrical move here would have been to the one fib at 12,357. But you can see you got into this quadrant right here. And this is where I anticipate you're going to come back down to. Okay, you're going to start losing this. This is a topping action here unless you can break out. And that actual number being 12,815 versus 12,718, 100-point difference. But you want to break out. And if you did see some type of breakout, if you got some retracement here, you did see some type of breakout, that's where you could see your retracement is at that next level up, pull back down, and then pivot out to the upside, okay? So these are key areas to look at for upside resistance, and as well you can use this for downside. And let's go ahead and do that. Let's just pull a fib retracement. I measure waves. If you guys are new to the channel, I trade with some very advanced Fibonacci concepts looking at impulse moves, but you can also just grab a fib retracement and pull this to the upside. And you can see your first target here for support is all the way down at 12,047. So there's different ways to measure this and get a shorter target. And you can see this on smaller time frames. Let's go ahead and do that. Smaller time frames, if you want to get some more immediate targets for support, one easy thing you can do here on the NASDAQ, guys, you can look at your impulse up, okay, where you impulsed from after you went sideways in Wyckoff accumulation, okay? So you can pull this just like this and then look at that. So your 382, you have at 12,483, bounced right off on this candle. Your 46 is 12,373. And again, on the daily, this looks to me like you're printing a double top already. You see this? You have the double top structure, volatility in your range. If we were going to mini cough this, you would do the exact same thing. You could simply just throw, actually, let's just throw the fib on here because it may already be in a mini cough type structure. Go ahead and mimic that same fib movement that we did on the 3-day chart. Pull this down, and you can see our 1272 at 12,815. I mean, this is essentially your boxed in range right here. You need to see price come up, pivot out to the upside, or start making series of lower highs or double top, come down, and trading view. Not now, 21 minutes in, come on. Come down and pivot up or come down, back test your resistance 12,357 and fall to the downside. So if I was day trading the NASDAQ, I prefer the Russell because the Russell has like 25% of the companies are zombie companies that can't even service their own debt. But if I was day trading the NASDAQ, guys, obviously you're looking at areas of key resistance such as the 12,815 that you've tested, had supply dumped on you multiple times, and you're printing a bearish structure that may come back up for a double top, okay? And then you're looking at your areas of key support. You can go down to the smaller time frames and really dial in your fibs as well. Your 200 moving average is down here at 11,918. So this is topping action going across all of the indices. You're seeing this. They're starting to form what could be double tops, or perhaps you could end up forming double bottom structures, right? Which would be bullish. You could form a pattern like this, then come out to the upside. So all things you have to watch, especially watching that VIX and just watching how the market reacts to all of the news and all of the information. Hope you guys enjoyed this video. Definitely like, subscribe, tick the notification bell if you have not done so. And I'll talk to you guys next video. Next S&P video will be on Sunday, guys. Take care, everybody. I'll answer your questions and comments as always.